Now, for example, we just talked about 1996 to about 2000, and let me look back just for a second. Sorry, this was about 2010. So 2010 would be right around here. So what you're doing here is you rode this wave up, you either switched strategies or you got out of the market and repeated. You can see here where you can buy your position if you use just a Darvis box, as we discussed before. As soon as the price action breaks above the Darvis box, one, you were out and now you're in again. And same thing here with the Jarvis box concept. Out and then in, and now you're riding this wave. Now you're looking for the next opportunity. When can I add to my position size? Once the price action broke from above resist through resistance, the resistance became support. That's a confirmation to add to your position size. So you can add more here. Now you're hitting a new resistance level. You can take some off, lock in some profits. Now all of a sudden the price action broke through the resistance, became support, and now you're riding the next wave. So you had a nice, beautiful run here of when to buy, when to get out to make money in this market. And you can see since then the market has been rising. But if you had to retire around this period of time, you really need to, no one's going to call you and tell you unless you watch someone like me or other active, experienced traders. No one's going to call you and say, around this period of time, you should be cognizant that you need to get out or minimize your position size or get out or switch strategies. If you don't know, get a mentor because the impact on your 401k is going to be gigantic, especially as you approach retirement. So again, locking in profits near the point of resistance and then adding to your position size as you bypass, as the price action cuts through the support, cuts through resistance and goes through support and starts rising and locking up profits in along the way. That's how you should trade. So Buffett's investing process, a simple but powerful framework. Understand the business. What does the company do? How does it make money? Evaluate the moat. Does it have a sustainable competitive advantage? Analyze its financials. We discussed the balance sheet, high returns, and consistent cash flows. Assess the management. It should be honest, capable, and shareholder oriented. Determine its intrinsic value. What is the business really worth? Enter a margin of safety. Buy at a significant discount to intrinsic value. Ideally, wait for a drop in the market. Ideally, a major pullback, at least 20, 30%, or during a recession. Um, get in. Buy with conviction when all the boxes are checked. Hold for long term. Let time and compounding do the work. Again, from the last slide I showed you, I kind of disagree with this. If you're younger, yes. If you're older, try to lock in profits while you can and don't give back the market all your gains. Review and be patient. Ignore noise, let fundamentals win. Our investing philosophy is very simple. Try to be fearful when others are greedy and hungry when others are fearful.